Good morning. This is Driving Markets, driving while talking about markets. Let's have a look at what was driving markets last week and will be driving markets this week. Remember, anything said in this piece is an opinion only. So last week, the two major events. First one was the FOMC minutes that came out of the January meeting, far more aggressive and far more irritating to the markets than expected. And that irritation sent the equity market south and sent the dollar up. Why? Because it looks like the governors were in favor of raising rates higher. At least two governors, one of them James Bullard of the St. Louis Federal Reserve. He wanted to raise rates by at least 50 basis points. Okay, so there is a sentiment within the FOMC, within the Fed governors themselves, that want to be a bit more aggressive regarding interest rates, and they believe that interest rates need to rise faster and higher in order to tame inflation. Friday came out a major inflation indicator, which is called the PCE, the Personal Consumption Expenditure, and that is a measure favored by the Fed on inflation. Why is it favored by the Fed? Because it shows the actual purchasing habits and the consumer habits on the consumer spending amongst Joe public in the US, and that came in much higher than expected, sending equity markets south and sending the dollar flying. In fact, the DXY index, which is the dollar index, the dollar index that measures the strength of the dollar, is trending upwards, looking like there's going to be more interest rate rises or expectation of dollar strength throughout 2023, when we thought maybe that the dollar has probably peaked and we thought that maybe interest rates have peaked. I personally have never said that. I've said that interest rates are going to go much higher and inflation is going to go higher. And some of the viewers, without names being mentioned, Phil, for example, have said that inflation is not going to go higher, but inflation is going to go higher because it is wage dominated. In other words, wage inflation is pushing inflation up. Also, wholesalers and manufacturers are taking advantage of prices, and they're layering on the prices or layering on the profits and not reducing the costs, or not reducing those prices in relation to the wholesale goods or raw materials that should be cheaper. They are cheaper, but manufacturers taking advantage of this and adding further to their bottom line, to their profit line. Okay. Now, Jamie Dimon of JP Morgan, the head of JP Morgan, came out. By the way, there was a survey said that JP Morgan will be worth $1 trillion by 2030 in 7 years. So those who want to invest in JP Morgan might be an opportunity, because apparently they're going to be worth $1 trillion in 7 years' time. Anyhow, so Jamie Dimon of JP Morgan said the Fed has lost control of inflation, or doesn't have full control of inflation in the US. And I've been saying this all along. So what was driving markets last week was the fear of inflation, the fear of rising interest rates. That is going to continue. Okay, the 10-year US Treasury yield is up to 3.95%, not price, percent. Those who are listening and corrected me last week when I stated a price, that was an error. It's percent, 3.95% on the 10-year Treasury yield. What is going to be driving markets going forward this week? Okay, so driving markets this week is going to have got a bunch of economic numbers coming out. Got durable goods out in the States, which is a volume measure of dollar-denominated goods produced in the States. Okay, that's if the number is higher than expected, that is bullish for the dollar, and if it's lower than expected, it is bearish for the dollar. You've also got ISM, Institute of Supply and Management, numbers out on Wednesday in the US, and we've got also ISM out, non-manufacturing, so that's the service sector, Institute of Supply and Management, PMI, out as well, Purchasing Managers Index. And those indices, one's the manufacturing and one's the non-manufacturing, both of them take a survey of around about 300 companies of the purchasing managers within those companies to give an indication what is the economic activity within the US. So it's quite an important measure, very important to keep an eye on. You've also got French inflation number out. You've got German inflation number out this week, which is expected to be lower, so trending downwards in Europe. And then you've got the Eurozone overall inflation number coming out, expected to come in at 8.2%, down from 8.6%. But I don't believe that inflation is going down in the Eurozone. And therefore, I think they're in for a shock when those numbers come out this week. I think what you're going to have a trending up on inflation in Europe and a trending up on inflation in the UK. And of course, as proven right, you've got a trending up of inflation in the US. So I can see inflation in the US reaching 8-9% this year. Okay, where are we at now? Probably by June, July, I would expect about 8% inflation in the US, and interest rates running at 6% by June, July this year in the US, and that will give further substance and further strength to the US dollar and push equity markets down. Now, equity markets on Friday, the Nasdaq suffered the most as far as percentage-wise concerned, because the Nasdaq is susceptible to high interest rates. Okay, it's totally dependent on cheap money, and those shares that are trending downwards, the Googles, the Microsoft, the CRMs, Tesla and Meta, also trended down. Remember, I've called Tesla down to $140 a share. It's well overpriced, was well overpriced at 208. It's come down. It will continue trending down to $140 a share. And I expect also Facebook, which is Meta, to come down also to that level, about $140 a share. As far as Bitcoin's concerned, remember, we called Bitcoin topping out at 25,200, big resistance level. It's come all the way down to 22,800. Overnight it's about 23,000, but I expect it to continue trending down to around about the 21,000 level in the near future, even going down to 20,000 before it completely collapses in 2023. Anyone who's following Bitcoin or trader on cryptocurrencies, as rates rise, the cryptocurrencies will become higher risk. They're already high risk, but they will be dumped as far as rates are concerned when rates rise up, and therefore those crypto traders can expect a bear market to continue in cryptocurrencies all the way through to June, July, and the rest of 2023, in my opinion. Regarding foreign exchange, dollar yen. Okay, dollar yen, I've said already, from 129, now it's 136.5. It's trending up to 140, and it's probably going to go to 145 in the near term. What's the near term? The next week or 2 weeks. As far as euro dollar is concerned, I expect the euro to continue falling against the dollar because of the rising interest rates in the US. And also, as far as cable is concerned, pound dollar, unfortunately I'm a big fan of the pound, but I think the pound is going to struggle at these levels. It's going to get big support at 118, 118.5. I would expect a bounce from there back up to 121 to 122 as far as cable is concerned. US dollar, Swiss franc, I expect the Swiss franc to be slightly stronger against the US dollar as a safe haven, purely on that basis. Interesting one to look at is oil. Russia is already cut production by 500,000 barrels, and it looks like it's going to continue cutting production in order to maintain the price up there. Oil's not going to fall anywhere significantly lower than it is at the moment, and it looks like OPEC and the oil producing companies will cut production in order to support the price and keep it up there at $80-85 a barrel. Gold is floated all the way down to 1820. It's going to test the 1800 level. From that point onwards, it's a big question mark where it's going to go. I think it's going to bounce back up to the 1870 level, but 1800 looks like the major support as far as gold is concerned. You can share, subscribe, comment, catch me also on Instagram and on TikTok. Give me some feedback. Let's get this channel going. This is Mayor Valensky with Driving Markets, driving while talking about markets. Everything said in this piece is an opinion only.